The AiRWA Inc. YYAI stock closed on Friday, October 24, 2025, with a last trade price around $0.0934 per share, following a highly volatile day that saw the stock trade between a low of $0.077 and a high of $0.10, with a staggering volume of nearly 500 million shares. This level of trading is completely disproportionate to its tiny market capitalization, which sits around $1.15 million, and it's a clear signal of extreme speculation. The immediate, unexpected insight that challenges the common narrative is this. While AiRWA has just announced a massive, high-profile pivot into the digital asset and Web3 space centered around its new AiRWA Exchange for Tokenized U.S. Stocks and Real-World Assets, RWA, the stock price has utterly collapsed. In fact, following the high-profile announcements about a $500 million joint venture and a $30 million Solana token investment, the stock plummeted over 90% from its recent highs. The market expectation, fueled by the company's bold statements, was that this was a significant opportunity to get into a Web3 platform with millions of users on day one. The cold reality, however, is that this strategic shift was immediately followed by a steep, highly dilutive equity offering and the announcement of a 1-for-50 reverse stock split scheduled for the immediate future, which is the exact opposite of what speculative investors want to see. This tension between the promised digital future and the current, brutal financial restructuring is the core of the YYAI story right now, and it's a masterclass in how speculative fervor meets financial distress. The general belief circulating among retail online investment circles, particularly those trading on platforms like Robinhood, is that AiRWA is a pure-play bet on the tokenization of finance, specifically leveraging a $500 million joint venture with Jucoin Capital to launch the AiRWA Exchange. This exchange is positioned to allow crypto enthusiasts to trade tokenized representations of traditional assets like Tesla stock or Apple stock instantaneously on the blockchain, bypassing traditional settlement times. The market hype was temporarily validated by the announcement of a $30 million commitment in Solana tokens, which instantly gives the exchange a high-speed, low-cost backbone and aligns it with a major blockchain ecosystem. This narrative creates the expectation of explosive growth and value. However, the deeper reality is one of survival. The company, formerly known as Connexa Sports Technologies, initially dealt with sports technology and digital matchmaking, a business that clearly lacked scalability and profitability. The abrupt rebranding and strategic pivot into Web3 were necessary moves to try and save the NASDAQ listing, which requires a minimum bid price. The stock's dramatic crash immediately following the transformative news suggests institutional capital and experienced individual brokerage investors were far more focused on the dilutive nature of the financing required to fund the new venture, and the subsequent need for a major reverse stock split just to stay compliant with NASDAQ's minimum price requirements. The volume surge is a mix of speculative buying and massive selling pressure from those recognizing the painful financial engineering underway. The decline from a high of over $2 to the current sub-$0.10 shows how fast market sentiment can turn when highly speculative good news is immediately followed by bad news on the capital structure front. This is a crucial lesson for anyone engaging in self-investing in the microcap space. Focusing on the recent stock dynamics is essential to understand the current price. The historical price chart looks less like a gradual change and more like a cliff. A staggering drop of over 90% in just a few weeks is not market noise. It is a fundamental repricing of risk. Institutional ownership in AiRWA is minimal, totaling less than 3% of the shares outstanding, a figure which speaks volumes. The few institutions present, such as Vanguard and Geode Capital, likely hold their small positions through passive indexing strategies, such as those that underpin many Fidelity ETFs, or are managed through Fidelity's broad market offerings, rather than a strong conviction in the company's new direction. Crucially, we've seen insider buying activity reported, with a 10% owner purchasing over $1 million worth of stock immediately after the steep decline. This is one of the few positive signals the bulls can cling to, as insider buying often suggests confidence that the stock is undervalued. But even this signal is complicated by the extreme volatility and low market cap. The pending 1-for-50 reverse stock split is the next major event. While necessary to potentially regain NASDAQ compliance and avoid being moved to the OTC markets, reverse stock splits in microcap stocks are almost universally viewed negatively by the market, as they tend to enable further dilution down the line and often result in the share price drifting back down. This split is the reality check that grounds the lofty Web3 expectations. It reminds everyone that beneath the innovative business model lies a company wrestling with severe financial challenges and a stock price teetering on the edge. The company's reported strong gross profit margins are a small silver lining, suggesting the underlying business model, whatever it currently is capable of generating revenue efficiently, but this is overshadowed by its negative profitability overall. To establish a clear foundation, we need to know what AiRWA is. The company's original business, under the Connexa Sports name, centered on a mix of sports technology, specifically providing practice equipment for ball sports, and digital matchmaking solutions through a majority-owned subsidiary. It was frankly a collection of disparate businesses struggling for relevance. The recent pivot to a financial technology focus with the establishment of the AiRWA Exchange is an attempt to escape this unprofitable past. The new business model is predicated on being a major player in the tokenization of real-world assets, RWA, aiming to fuse the traditional financial world with the blockchain. This is an exciting, high-growth area. The potential is to capture market share from traditional investing sites and platforms like SoFi by offering 24/7 near-instant settlement trading. The joint venture with Jucoin Capital and the $500 million committed funding are designed to give them the scale and legitimacy needed to compete in this new market, potentially providing access to Jucoin's ecosystem of around 4 million users right at launch. This strategy is audacious, but its execution is inherently linked to regulatory approval, technological security, which they are addressing through a partnership with Inca Digital, and most importantly, the ability to maintain a stable, compliant listing on a major exchange. The shift is so profound that investors need to entirely relearn the company, setting aside the old sports tech segment and focusing solely on the viability of the AiRWA Exchange. The future outlook for AiRWA Inc. is a perfect illustration of the expectation versus reality principle. The expectation is that the AiRWA Exchange will quickly capture significant market share in RWA tokenization, driven by the massive capital commitment and the technical advantages of blockchain trading. The company's ability to successfully conduct test runs for tokenized U.S. equities validates the technical aspect of this expectation. The potential upsides include rapid revenue growth if they can successfully monetize the millions of users from the Jucoin ecosystem, and the possibility of becoming a first mover in a nascent multi-trillion-dollar segment. The reality, however, dictates caution. The immediate implementation of a 1-for-50 reverse split and the necessary capital raising that led to the severe dilution suggest the company was in a much more precarious financial position than the high-profile press releases indicated. The short-term pressure is entirely on avoiding delisting. If the stock trades below the NASDAQ-mandated minimum price for an extended period, or if the reverse split fails to lift the price permanently, the listing itself is at risk, which would be catastrophic for investor confidence and access to capital. Furthermore, the Web3 space is highly competitive, and while platforms like Fidelity Investments and Interactive Brokers are taking baby steps towards crypto, they have the balance sheets and regulatory compliance history that a small, recently pivoted company simply cannot match. The success of the AiRWA Exchange will depend heavily on the regulatory environment for tokenized assets, which is still highly uncertain globally. For those who invest online, this is a fascinating but treacherous scenario. In conclusion, AiRWA Inc. represents the ultimate high-wire act in online investing today. The narrative, a bold, well-funded pivot into the future of finance via RWA tokenization and the AiRWA exchange, sets a high expectation. This story is what is driving the speculative volume we see. However, the immediate reality, the catastrophic stock price collapse, the necessary heavy dilution, and the impending 1-for-50 reverse stock split is a stark reminder of the deep financial distress the company is facing as it attempts this transformation. The success of the Web3 platform is the long-term play, but the short-term focus is purely on capital structure and NASDAQ compliance. The stock's movement is currently driven less by its product potential and more by the technical forces surrounding its survival. Comment below what percentage of your intelligent